We've been talking about him and his call all day. The financials, the worst performing group in today's session. Our next guest making a big call on that space this morning really dictated a lot of the trade today. Canaccord's Tony Dwyer has downgraded the financials. He joins us now. Tony, it's good to see you. Welcome.
Great to see you, Scott. And I think you give me a little too much credit, but thanks, buddy.
I mean, look, your call was much talked about, which basically says downgrade the financials. They've run too far, too fast. Rates are going to top out. All of the financial stocks were down today. Rates blipped down a little bit. Explain your call.
So, Scott, if you remember last May, I think I was on the halftime or on FESMA. I'm not sure which one, but on May 26th, we went on offense and we thought that the incredible monetary policy stimulus that had coming fiscal stimulus as well was going to be enough to get the economy going again. So we went on economic offense. Since that time, and that was a banks, quote unquote, banks and tanks call. Since that time, the financials and industrials, believe it or not, most people can't believe it, are the top two performing sectors in the S&P 500. So when you couple the gains that you've had there, especially in the last few months, with the rate of change in the rise of the 10-year note yield, it's never gotten to the kind of level we're at. And people would say, of course it hasn't, because it's as low as it gets. We have exponentially more debt, so I discount that. We've just had such a sharp rise that when it's been this sharp, when it's been this sharp before, and pulled back, sorry about that, and pulled back for a week, which it did, it's a signal that you're going to peak out in the relative performance for the financials. So again, this isn't a, oh my God, the sky is falling. We're new in an economic and market cycle where excess liquidity is going to fuel this synchronized global recovery. This is a call that over the next 1 week to 3 months, you're going to get an underperformance of financials based on a stabilization.
Only if rates are done going up. Right. I mean, that is the wild card in this whole call. It only works if rates stop going up from here.
Well, the bulk of it's behind us. It can go up a little bit more. In the two instances where you got over 50 on the 10-week rate of change and then you peaked and pulled back, rates actually in one of the instances went even higher, but you had still peaked out the relative performance because everybody on the planet thinks rates are going to go higher. And that's already to some degree discounted in the financials. So again, it's more of, the fundamentals aren't bad, but it's just, it's so visible that it's showed up in the gains in the space.
Yeah, I want to bring in Grasso because, Steve, you disagree with Tony and his call. So let's get it on a little bit. What's the issue that you have with his call today?
So I like that Tony said that it's a short-term call. So I have no problem with that. Markets can change, ebb and flow on a daily basis. But when you look at the XLF, back in 2007, they topped out at basically 31. In 2018, a little over 30. 2019, 31.04. 2020, 31.38. We've broken trend. This is not our mother and father's stock market any longer. This is a value play that's coming on strong. It's not just about the yield curve. It's not just about the 210 spread that's at a 5-year widest measure as we've seen. This is something that we're going to see a boom of an economy that we have never seen before. We're coming off of a pandemic. The last one was 100 years ago. So, Tony, when you look at the financials, I agree that you could see a little bit of a flattening of the financials, but you would have to agree that the trend is still higher for value, and financials are at the epicenter of value with yields moving higher.
So, Steve, I've been saying since last summertime, and I will not change it. I cannot imagine a situation where I'm going to change it because of the excess liquidity that's fueling this recovery. We've never seen this level of liquidity. So this is a multi-year call on economic recovery, right? This is not a multi-day. It wasn't a 2-quarter call that I made. There are periods in that, just like any new bull market, where you don't want to chase it because when you chase it at such a high level with real data, this isn't my opinion, it's what the data has shown. With real data, the problem is you tend to sell it inappropriately. So I would rather attack weakness than fear it and then make a mistake on weakness. There's no question in my mind. Go ahead, sorry.
No, you go ahead. When you say there's no question in my mind, I apologize for stepping on your toes there. Finish your thought, Tony.
Buddy, there's no question in my mind that we're in a new bull market. We are in a new economic cycle. The last thing you want to do is get overly negative knowing that. The problem becomes when you get drawdowns, it becomes painful, and people, unfortunately, sell it instead of buy it.
I'm just not – I don't know if people are ready to stop buying growth stocks, right, because that's where the action is. That's where the action's been. That's where you get the highest rate of growth in what still is going to be a reasonably low interest rate environment. Tony, I hear you on your near-term tactical call, but longer term, aren't traders going to revert right back to the growth stocks that got you here? You dance with who brung you, and they're the ones who are going to continue to be the dance partner.
Well, Scott, you would think that, except financials and industrials are the top two performing sectors since last May. So, yes, you had and by the way, it was an idiot call right up front. And for 2 months, it was wrong. But you had such a move and a thrust in those growth stocks that you need a true anticipation of economic weakness. Remember, what really favors those mega cap predictable growth names is when you have a fear of economic activity, right? And that comes when you have a shutdown in money availability. We have a record level of money availability here. So ultimately, that's where I believe we're in a new economic cycle where you want to buy weakness into the economic reopening theme or recovery theme, because there is that liquidity to really support growth. You can't support growth if you don't have any money. We have a never before level seen level of money.
Yeah. Tony, good stuff. Appreciate it. Enjoy the weekend. We'll talk to you soon. That's Canaccord's Tony
30
Blair
years
there.
of doing this, 30 years of doing this, guy, you figure I would have muted my phone. So sorry about that, and have a great day, guys.
Yeah, you as well. That's the brave new world of doing all this from our homes. All right, Tony, we'll see you soon. All right, Nadine, you heard the argument, or at least the conversation. What's your opinion here?
I mean, I think he's right, obviously, on a one-day short term. We have daily risk ranges. So yesterday it was pretty obvious that financials were overbought, treasuries also oversold, so you could cover your shorts on long-duration treasuries. But when you look ahead, right, and I think that that's what Steve's point is that yields probably are rising. Financials are under-owned, just like energy. And if you look today, financials are at implied volatility premium. That means that people are still paying a lot for protection on financial names. And it means, therefore, that they probably have additional room to run. So if you see yields at 1.9%, 2% on the 10-year, you're going to have a nice return on those financials. So I have to disagree with Tony. I still think there's room to run. I'm going to agree with Steve on it. But from a day-to-day trading perspective, Tony was right today.
Shepard Smith here. Thanks for watching CNBC on YouTube.